All right, picture this. It's 1987. Wall Street is well, a blizzard of cocaine and ambition. The Dow has been on a 5-year tear, basically a vertical line up. Everyone's a genius. Everyone's rich. And in the middle of this party is a guy named Paul Tudor Jones. And he's looking at the champagne and confetti and he's not celebrating. He's preparing for the apocalypse. I was just a junior quant back then, barely old enough to buy a beer, building models that everyone thought were infallible. But Jones, he was different. He wasn't just looking at the numbers from that day, he was looking at ghosts. His head of research, a guy named Peter Borish, did something brilliant. He took a chart of the stock market from the 1920s, right before the great crash of 29, and he literally laid it over a chart of the 1980s market. The result was chilling. It was a 92% match. It was the same pattern, the same manic climb, the same euphoria. Jones was staring at a blueprint for a disaster that had already happened once before. But it wasn't just a historical echo. The technicals were screaming red alert. The market had broken below its 200-day moving average. Now, for us quants, that's not just a line on a chart. Think of it as the market's long-term heartbeat. When the price crashes through it, the patient is having a heart attack. It was a classic signal that the bulls were exhausted and the bears were about to feast. And then there was the secret weapon, the thing most people didn't understand, a little product called portfolio insurance. It sounds safe, right? It was anything but. It was a dumb algorithm, a computer program designed to automatically sell stocks and futures as the market fell to protect investors. Jones saw the flaw immediately. What happens when everyone's insurance policy is to sell at the same time? A small fire becomes an inferno. A little selling triggers the programs, which forces more selling, which triggers more programs. It was a doomsday machine and nobody saw it. So what does he do? He bets against everyone. He goes short. Massively short S&P 500 futures. He was basically buying fire insurance on a house that he was certain was about to burn to the ground. And on October 19th, 1987, Black Monday, the house burned. The Dow fell 508 points, a 22.6% drop, the single biggest one-day percentage loss in history. It was pure chaos. Grown men were weeping on the floor of the exchange. Fortunes vanished, but Paul Tudor Jones, he was calm. He was right. His fund didn't just survive. It reportedly tripled its capital, netting him personally about $100 million. Now, here's the most beautiful part of the trade, the part that separates the legends from the gamblers. It was an asymmetric bet. See, Jones was a fanatic about risk. His rule was simple. He would only enter a trade if the potential reward was at least 5 times bigger than the risk. For his Black Monday bet, his downside was capped. He used stop losses. If he was wrong, he'd lose a little bit, a scratch. But his upside? His upside was a total market collapse. He was risking $1 to make 50. He was risking a paper cut for the chance to win a kingdom. That's the whole game. It wasn't about being a pessimist. It was about seeing reality when everyone else was drunk on delusion. It's about finding that one bet where the world thinks you're crazy, but the math tells you you're the only sane one in the room. And those opportunities, they're rare, but they're how history gets made.